Nick Erner. I'm the Managing Director of Alkane Resources, and I'm here today with Frazer Bourchier to discuss the merger between our companies, Alkane and Mandalay Resources.
Yes, I'm Frazer Bourchier, the President and CEO of Mandalay Resources. Really excited to share this story with you.
Guys, welcome to London. Thanks for coming all the way over here. I suspect you've got one or two meetings lined
Just a couple, mate.
Just a couple. Good. And I saw you both back in September. I think we saw you Beaver Creek, Colorado Springs.
Yeah. Denver Gold, yeah.
Been a bit busy.
Yeah,
We've been busy for a while, yes.
Well, look, we're here to talk about this, we call it merger of equals, but what is the actual construct of this deal potentially? You still got to vote, right?
Oh, yeah, exactly. So this is pro forma Alkane taking over Mandalay. It's a merger of equals, but the actual legal method is that on the Toronto Stock Exchange, wherein the combined entity, which will remain and trade under Alkane Resources, will be 45% of the entity will be held by existing Alkane shareholders and 55% by Mandalay shareholders. So it's got full board agreement, voting support agreements lined up. In mid to late June, we'll actually vote on it, on each party, and then it should settle soon after that in July, late July, early August, yes.
Okay, so you got it. We need 2/3 approval, 50% approval of the attendees.
Yeah, of those that vote. Yeah.
Of those who vote. I guess each side's got to work out what the other side is bringing to the table, because shareholders obviously pick their favourite child initially. So why don't you can remind Mandalay shareholders what exactly Alkane brings to the table?
Yeah, well, so absolutely, both of us have been, Fraser can expand on this, both of us have been looking for a transaction similar to this for quite some time, right? Quite some time. And what do we bring to the table? So Alkane's ASX listed, and we have our Tomingley gold operation, which is, should do a bit over 70,000 ounces of gold this year, with a runway to being in that 75 to 80,000 ounces, plus the opportunity to expand, as well as large as a gold, copper porphyry. So we've got this engine room production over the next 7 years lined up already that'll be generating significant free cash. And then that is a bolt-on block to a much larger organisation. So for ourselves, the next stage of growth was either going to be through M&A or through development. But we didn't have that development project. We were searching for that. And so we found, with Mandalay, a similar desire.
Yes, I mean, 70 to 80,000 ounces, we bring 90 to 100,000 ounces. Pro forma, you're looking at 160,000 ounces to start, gold equivalent. Within a year, 180,000 ounces. We bring, at the end of March, we had just about $90 million US in cash and zero debt. We couple that together, pro forma, and we're accruing cash each month. Pro forma, let's say the deal closes by August. This company will have over $100 million US in net cash positive with no debt. 2 years left, or 22 months left of 17% hedged gold, at a market cap, mathematically, $650 million US, generating $200 million US free cash flow a year. That's a cash flow multiple of 3 to 1, 2 to 3 to 1. So, normally you'd expect EBITDAs at 4 to 5. So we still think there's a lot of room to grow. So it's quite compelling. We have a great share register now, trading liquidity, index listing, growth platform, cash generation, 3 producing assets, another project build. It's pretty compelling. We're really excited.
Right, so it's genuine growth that you're looking for, and
yes.
Re-rate is a word that I think you've used in the marketing material a lot, but because a lot of companies come on here and it's from a position of desperation, act of last resort. This does not seem to be that. So when did you two meet? Sounds like a dating club here.
Exactly. But you're right.
It wasn't at a disco a year ago. No.
This is exactly about accelerating both of our growth ambitions.
Yeah.
Right. So if you look, both of us have organic growth opportunities, which I'm sure we'll dive into. But if you look then at that next stage of growth, and obviously, you and a lot of people watching the channel have talked a lot about the relevance of liquidity, the relevance of balance sheet, access to capital, scalability to attack assets. So that's what we're trying to bring for both the party. But I guess Frazer specifically hired to try and create a transaction for Mandalay.
Yes,
Do you want to
yeah.
give
Look,
the history?
I think when I shared with you
Yeah, it
when
was
we
great.
met back in September, when I joined Mandalay 2 years ago, I wasn't really brought in to run the company. I was brought in to grow the company. And we set a very clear vision to become a mid-tier producer. And that strategy was focus on the operations, build cash, clean up the balance sheet, organic exploration, great. But if you really want to fundamentally change the story, the third pillar or leg of that stool was M&A, whether it was asset acquisition, mergers of equals, take out, take under, whatever. That allows you to get that capital relevancy as long as it's accretive and non-dilutive.
Explain that for people, because it's like you're both doing fine, but you're of a certain size where indexes, funds maybe find it easy to kind of skip over and move on to the next thing.
Well, not find easy, they're just not eligible. You have to have a certain amount of size, trading liquidity, whether it's dollars per day or shares per month. We didn't qualify for either JDXJ or obviously ASX 300 because we're just TSX listed. Nick can tell you what they qualified for, which was just one of those two, right? So there's part of that element in index listing, which is a big part of it.
And also, so for instance, Frazer and I have done a whole heap of marketing off the back of this. So, 50, 60, whatever it is, meetings, through Australia, Hong Kong, Toronto, New York, and here we are in London. We're got other stuff in Europe. And so, for instance, we've run into funds, which we already knew existed, all part of the strategy, you know they exist as well, where they might have, $1 billion, maybe more under management, small team, but the minimum ticket size that they'll write might be 20 million, 30 million, 50 million, US, Aussie, Canadian, doesn't really matter. But they have no desire to be more than 5% of the register, right? So, and then they need to be able to invest that position and remove that position. And so they need to see the liquidity that's going to let them move $50 million in without disturbing the market too much, remove $50 million without crashing the market, but at the same time, not be more than 5% of your company. So if you're not $1 billion company, that fund isn't coming in. If your liquidity isn't $5 to $10 million a day, then that company can't get in and out smoothly. So that's super relevant and becoming more relevant all the time because this, we've discussed before, fundamental investors, firms tend to follow and more people use buying into ETFs and passive funds as well.
Well, let's explain the different, because you're totally different exchanges, and I know the twain shall meet sometimes, but it seems to be more and more fashionable. But ASX 300, what does that potentially bring to you? It's sort of following on from what you've just said.
Yeah, so the entry point for the ASX 300 is circa $700 million Australian market cap, right? And it rebalances twice a year in September and March. And so what that means is that there are exchange traded funds that are on the ASX and potentially other exchanges as well that invest in the 300. And like as people know with an index fund, if top company one is 5% of the market, then 5% of the fund is held in that. If you're down here at 300, you might be 0.1% of the index and 0.1% is held. But depending on their trading frequency, that might be traded daily, weekly, monthly by the index fund itself. And so that just provides liquidity and turnover that happens because of it. Now, when the money first flows in, then obviously the price must lift because typically have more buyers and sellers. That's something we anticipate could well happen for us entering the ASX 300. But at the same time, once you're in there, the liquidity that provides allows normal investors to come in and out much easier. So hopefully that gave a sufficient explanation for anyone.
And for the Aussies, GDXJ works in a similar way, but what can that bring in terms of liquidity? What has it?
Well, look, for the JDXJ, now the market cap pro forma is larger. So there's an automatic uptick in the rebalancing there as well. So look, index listing, to have capital relevance, index listing is important. It's not the only part of the story, but being qualified now for 2 indices, having a much more widely distributed share register. You may recall, Matt, when we spoke back in September, Mandalay was like a semi-private company. We had 4 shareholders that had 75% of the stock. The largest shareholder in the pro forma is going to have about maybe 18
Would be less.
Or even less than that.
13%.
Yeah, 13%. And it's much more widely distributed. So it's healthier trading, index listing. You couple that now where the ASX tend to have healthier, more generous valuations for mining companies at a certain size versus the TSX. So we think there'll be a re-rate level there. And in a minute, we'll share with you the future as well. This is just not as simple as combining and it creates this great platform and, drop the mic and move on. It's not that simple. It's great. It's part of the story, but there's a lot more to it than that. So, diversification of assets, diversification of geography, and we still remain tier 1 jurisdiction. We didn't, have to, go into, maybe parts of the globe that are a bit more risky. We accomplished this, and we're very happy about that.
Okay, well, and let's look. I don't necessarily want to do a whole session on each of the assets because we can do that another time. We'll come back into that because we've done it sort of separately. Let's talk about the kind of, I guess, the symbiotic nature of this. You've explained obviously indices and potential re-rate components, which hopefully people will understand. But there's savings to be made as well, presumably, because these things are hard fought and hard come by. A lot of these deals start but never finish. You're at that point where you're going to present it to your shareholders, respective shareholders, and hopefully they vote the way the board is and management have suggested. But what is the working relationship? What are the savings? And maybe give us a clue as to how this thing will operate moving forward. And
so a couple of things. Working from the board down and then coming through. So firstly, the new pro forma board will have, basically, we are a true merger of equals. So we have a Mandalay-dominated board and an Alkane-dominated management, mostly because the two of the three assets are in Australia. Right? So the Mandalay-dominated board has 3 members. Frazer is one, the existing chair, Brad Mills, is another, and Dominic Duffy, Australian-based director who has previously been the CEO of Mandalay. So that's 3 Mandalay side. On my side, there's myself as the Executive Director, Managing Director, and Ian Gandel, our existing Chairman. Plus, we have a new independent Chairman, Andy Quinn, who's just retired off the board of Barrick and is announced his intention to retire off the LBMA. And he's based, actually works in and out of London, but he's based in Wales. So we have a very highly credentialed board. Management, like I said, the important thing for people to realise is that both of us have similar values and we operate our sites pretty independently. We have a very empowered general manager on each site, and then we have light touch at a corporate level. So Frazer's COO, Ryan, and VP of Exploration, Chris, will both come to just join into the Alkane team. Okay. And so at a site level, not a lot really changes. And so in terms of synergies, there's $5-6 million worth of costs that we'll save, but the actual synergies come from what our capacity is to do other things easily and cross-support across different times of market cycle and development and that sort of stuff.
So it's not about, like you say, the savings usually sometimes are quite de minimis in that sense. This is a team that's built to drive that re-rate, that growth. You both said so what does that actually mean? It's
to drive growth. The re-rate may naturally happen, but it's to drive growth both organically and M&A.
Yeah, I want to touch on something else Nick said, which is there are certainly some savings and synergies, but the reality is we were both pretty lean model corporate offices. I had 4 people in my office. Nick has about 6 in the Perth office, me in the Toronto office. It was very much a mine-based model because we also get asked, well, how do you manage these different geographies? We have a very compelling model where it is based at the mine sites, lean offices. So certainly reducing one office will result in some saving, although we will keep the TSX listing. But it was real, and it's a bit more of an Australian-centric story for now. Yes, you've got 2 producing assets and 1 project there, Björkdal, Costerfield producing asset, Tomingley producing asset, and 1 in Sweden. But yes, it's more about the platform for growth and what's next after that and the way in which we operate, which is very similar.
Right, so it's a 24-hour news.
Yeah.
This is what we're dealing with here. So, and then let's just talk about the different exchange. Do they feel quite? Do you understand the TSX V? You want to go TSX or TSX?
TSX.
TSX, right? So I threw it. And does your team sort of understand the ASX and how those could work together for you? How do you? I don't want to say play this. How do you use that to your advantage?
Well, the advantage is just different investor pools, right? So of course, sophisticated investors, and by that I mean, funds, larger family offices, high net worth individuals, most of them are familiar or have an agent or broker who invests in the different exchanges, and it doesn't really matter where. Each retail base will tend to invest just in ASX or TSX or, NASDAQ or whatever in the US. And so, Mandalay has a retail pool that will continue to want to invest in the TSX. So yeah, of course, not of course, but yeah, we definitely understand the different jurisdictions. We in Alkane will need some specialty help in some of the aspects of the filings that we have there. That will be taken care of course, for Mandalay Shield, because Alkane's already doing that on the ASX. There's some slight differences between JORC and the NI 43-101s, but that's okay. So we'll simply update Alkane recording. But I think what's it about? It just means that we will have to do the work in both jurisdictions to make sure investors are informed about the prospects.
Well, JORC does have the advantage of it doesn't necessarily need to report the same amount of information that you do on the TSX. So
yeah, that's right.
A little bit more work.
Yeah, it's just a bit more work and making sure that you're abreast of two different sets of filings. But it's not a complete rework, right? There's a massive.
The information's there. It's whether you declare it or not.
And Matt, to be clear, the current Mandalay shareholders do not need to move their shares anyway. The Mandalay share may disappear. One Mandalay share will be converted to 7.875 Alkane shares, and it will trade as an Alkane share on the Toronto Stock Exchange. Yeah. But there's no need for that to be going over to the ASX. So we believe there'll be healthy trading on both, even if the ASX may be considered a primary exchange in the TS a secondary. I'm wary of using those words. We're not sure yet where that flow may be quite equal. Will there be a little bit of a difference in the price overnight? That's where the arbitrage and the ARB funds come in and keep that relatively tight. So that's not really that.
You were quite tightly held.
You
were tightly held for an Aussie company. I'm going to be polite because Aussie companies do love to dish out the shares typically. So your guys are going to have to get used to slightly different share counts as well, right?
Yeah, well, so for us, maybe I'll share and then Nick can explain on it. I mean, we were tightly held. We had very thin liquidity. I would say, ironically, a few months before this deal, our volume went up 10 times because our 4 major shareholders went down to 3. We still have CE, GMT, and Ruffer.
That was managed?
Yes, that was through a run up in the price. A number of European gold funds, other funds, and retail picked that up. So as Valora had been one of them, and they made a slow exit. They were very happy with their return. They saw more upside, but they had their own internal requirements on their fund, a generalist fund out of Madrid. So the volume had gone up 10 times, not yet enough to qualify for the G80XJ. Got closer. This merger, of course, takes it to the next level. But you're right, that's still 3 shareholders at 60% as opposed to 4 at 75%. Now it'll be 3 shareholders at 30%. So it's a much healthier distribution. But you're right. Nick can speak to what the shareholding is like in the Alkane.
Yeah, so we have circa 30% held by 2 different family offices, one of whom is our chairman's family office. And then other high net worth and small fundamentals. But then we also have a block already of sort of 12 to 15% of the shares held by index funds who are following the GDXJ as well. So yeah, we should certainly see a lot of opportunities for entry for other interested parties.
Does that help? You talk about liquidity is always important. It kind of helps move the price, liquidity, volume, etc. But this profile on the register of more institutional.
I mean,
would that help you?
It's totally. There's a double-edged sword with stuff as well. Like for instance, if everybody, let's just say, 30 institutions loved everything about your company and they each bought 4%. I know that's more than 100%, but you know what I mean? So they each bought whatever, right? and then you're left with just 10%, then you end up with a problem of how do people get in and out, and then just a few shares can trade in and out, and you don't have enough volume and liquidity to actually be on the indexes, even though you're an incredibly valuable company. So you need, you know, a real mix across your register of really long-term fundamental people that are interested in short-term growth, people that are just following gold and will trade in and out broadly on the gold, retail investors, again, falling across all those different categories as well. So, but certainly it is a chance for funds who look at the current ASX market cap valuations of peer companies who are making 160 to 180,000 ounces, look at their market cap, look at the pro forma market cap and think, hang on here, there's a mismatch, I can make money as they come together. Because that could be nothing, but it could be a 100% premium.
So when it was an all-share deal.
Correct.
And you know, describing some of the potential issues if you have too many institutions coming in, and how you kind of manage that. Is there a point in the future where you might look to raise some capital? I know you'd be throwing off a lot of cash. You said it well, Frazer. But maybe future M&A. Would you look to do it a different way next time around?
Yeah, look, I want to be clear. Nick and I represent 2 of the 6 board members. So we're careful not to speak on behalf of the pro forma board. That being said, Nick and myself, my chair at Mandalay, Brad Mills, Nick's chair at Alkane, Ian Gandel, the 4 of us sat in a room together about 6 weeks ago. And part of the purpose of that, before we moved into exclusivity and then announced the deal, we also wanted to ensure we had the same vision of what the future looked like after this. And that growth strategy, while it certainly now says, great, we've got 3 operations that are producing cash, a lot of cash, in great jurisdictions. We will probably ramp up our organic exploration around those assets too. But the third pillar of that stool, a bit similar to the one Mandalay had before to help take us to that next level, has to do with other M&A, whether it's asset purchases, development of a project, another MOE. So whether a capital raise is required or not, we want to be pretty clear that there'd be a use of proceeds, possible. But we will digest this over the next 6-8 months and be moving actively, and then make that decision and inform accordingly.
Okay, so sticking with that kind of the thought process, I'm always fascinated by the way that the management, the board think, because it gives me a clear as to what might happen in the future. Because a lot of people come in and say, oh, M&A. Always M&A. Very few deliver on that. 1, because it's hard, and 2, because they're not actually looking.
Well, I shared that with you when we delivered.
I know, absolutely. Very few. Is that kind of attitude to the way that you go about doing business is really, really important here. You know, in terms of being ethical and being aggressive and being ambitious, and that gives me a sort of sense of what could be coming down the line.
Yeah. I mean, the thing for people to remember is, there's a cost of capital that actually exists. So the reason Alkane exists, the reason Mandalay exists, the reason Crux exists is to make money for the investors and owners of those companies. So, and then the board, the management and the board are executing a strategy that they think and they've communicated that's going to go and make that money. So, one of the things for the future board, your pro forma board, to look at is, where do we want to allocate capital? Is that returning to shareholders? Is that organic growth? Now, obviously, there's an organic growth you sort of must do to stay in business. You've got to do, when you're mining, you're depleting a resource. You've got to expand and recover your resource.
Make some margin.
Exactly.
Right.
You need to be careful that you're not, chasing something ridiculous. So there's that balance and tension. And then there's also, of course, then is there a way to leverage your company's existing asset base in order to buy something at less value and do it? Which may be, let's say there was a development opportunity that had 0.2, 0.3 NAV. Of course, the reason it's low is because of the risk. And we're saying, here we are at 1 NAV, so our cost of capital is less. We can get into this asset and therefore make leveraged returns on behalf of our shareholders. So that's absolutely the things that we talk about in boards all of the time, right? Or sorry, in our board. I know that Mandalay has in their board, but the thing that people, I think, despair of is when people say, oh, I'm doing growth for growth's sake. No, it's all around what is the return on the capital employed and where else could the money have gone and what's the opportunity cost of that.
Right. Yeah. And this isn't, again, just sticking with this whole thought process thing, this isn't jumping on the bandwagon. You guys first met, not necessarily specifically about this merger, but you first met back in, 2023? I understood from previously.
The very first time, yes.
Very first time, right? So there was no necessary thought, but just inquisitive, I guess. But when did the actual conversation start? Because if I look at the antimony sector, the antimony hasn't been looking like this in terms of profile and price since 2010, 2012. It's shot up. People are super interested. Everyone wants to be antimony. But this isn't jumping on the bandwagon thing because antimony.
No, this isn't about
this. Is how do you come to this?
Look, whether it's the antimony price that has quadrupled.
Antimony.
Whether it's gone up 4 times. It adds to our revenue. It's great. The gold price has gone up significantly. But these are somewhat fortuitous events that don't change the thesis.
Right.
Of what we're talking about. Both boats of each company have floated up with that same tide, especially in a merger of equals that's accretive and non-dilutive and conserves cash. So that's certainly a benefit, but that's not the reason behind this.
Yeah, explain the reason behind it.
Well, I want to make it clear. I mean, sometimes the view might be, you're just getting big for the sake of getting big, or it's ego-driven. It's not about that. It's about, as we talked about before, capital relevance. We were micro cap. We move into a mid cap. It's about share trading liquidity. It's about index listing. But also, as a public company, if you have 1 or 2 assets, sometimes things happen at those assets. You manage them the best you can, but sometimes there can be a problem. And in public markets, you're kind of as good as your last quarter. And if you're not careful, it can lead to short-term thinking, to meet that market demand and get back in and get those on. When you have 3 or 4 assets, you still want to manage them carefully, but there's a bit more flexibility and you're not potentially put into a corner on making short-term decisions. So that's what we call the diversity of assets as well. You've got 3, then we get up to 4, then we get up to 6. I look at the stories like Northern Star. I look at the stories like Equinox. I may debate that one. Evolution, Endeavour. I mean, building that critical mass, it's not about getting big just for the sake of it. It creates that diversity and flexibility. And as long as you apply a discipline of prudent capital allocation and eventually never forget the return to the shareholders.
Is there in your mind, gold, I've heard people quoting 10,000, 50,000, whatever kind of. You've got to have a view in your mind about this environment and what you do with your cash. I talk about return on capital investment, but how much of a piggy bank do you hold in cash versus, I'm going to spend it, I'm going to plow my money back in the ground, as it were? What's that kind of balance on your balance sheet need to look like for both of your companies? Because I just see companies just spending.
Well, there's a big pro forma board decision to come on that, so we can't answer it too specifically, except to say, of course, our minimum cash reserves need to rise as a larger group, right? Because you're holding across.
But do you think gold's going to hold? Is this a sustainable price? Is that the way you're making business decisions?
We're making business decisions really based on getting the mine lives as long as reasonably possible, and we can talk very briefly about the cost, extension cost per ounce, which is very low for all 3 companies. Making the cost profile as low as possible, of which grade is a large part of that, and then making sure that appropriate financial instruments, be it puts or whatever, are in place, perhaps, right? Something to discuss and consider. It doesn't mean you'll do it. As well as capital returns should they exist, right? So all of those things are discussed. I mean, all of those places, you have to consider and put money, but it doesn't mean that people will agree. A lot of investors, if you just want absolute gold exposure, don't look at mining companies. Just go and buy gold.
Yeah.
Right. If that's all you want is gold exposure, go and buy gold. If you want leveraged gold exposure, then get into the mining. Or if you want cheap, there are other reasons to get into mining.
And Matt, to answer your question on cash, there's certainly a balance between holding too much cash, which puts you at risk as possible takeout, and premium on cash is 1 times, right? So you want to be careful, but you also like to keep some of your powder dry, in the event of whether a clear capital investment, organic exploration. So, we balance that between, if we ever accrued so much cash that we couldn't deploy it appropriately, then you should consider a dividend back to your shareholders in that. So, I have been through different companies. I'm generally, personally, averse to too much debt. I'm not a big fan of debt. You can argue debt to equity ratios that run you about 30% are healthy. Right now, ours is going to be well below that. We bring no debt to the table, and there's some debt that technically, as I shared earlier, you could clean that all up and have 100 million in cash and no debt, with a little bit of hedge left for 22 months afterwards. So it is a balancing act. It's always looked at the return of the shareholders, whether it's ultimately through share price appreciation, potentially dividends, maybe share buybacks. Those are things the pro forma board will always look at and make that decision accordingly.
Right. So you've got a few steps to kind of get through now. Obviously, the vote is one of them, and then papering it up afterwards. So be done by when? When are we looking at?
Look, there is the Australian Foreign Investment Review Board and the Swedish Foreign Direct Investment Review. Both of those we think are pretty routine, given the nature and the shareholdings of the company. So we think that, assuming those track as we expect, we think the votes will be in sort of early to mid-July, and we should be closing early to mid-August accordingly. Yeah, and then we take it from there. Yeah.
No one's going to be against a bigger company for all the reasons you've laid out today.
Yeah, look, we're both. Well, both boards gave unanimous recommendations to the shareholders that they should proceed after. As you mentioned, lots of debate, right? There's a lot of.
I imagine. I don't necessarily want to get into it.
Yeah. So yeah.
We think transaction risk is pretty low.
Yeah.
We have support for the 2/3 we require on our side. Nick can speak, but they're pretty confident on the Alkane side as well. So, never want to be presumptuous, but we feel it's a very compelling deal. Boards have recommended it. There is a break fee in the event of, and we would always allow for, if a superior offer ever did come in, of course, the shareholders have the right to consider that, and the board would weigh in on that as well. But we think this is, as we said, circular filing within early June, a vote 4 weeks later on both sides, and closing, by mid-August at the latest, we would think.
A lot of this needs to happen in the sector, right? We need the capital to be allocated to the place where it can make people the most money. Gold companies have a reputation of burning money. One of the reasons is buying assets with really big premiums at different points in the cycle. But when you have similar PNAVs and similar outlooks and similar methods of running, and your strengths and weaknesses complement each other, as in remove each other's, then absolutely should be happening. So yeah, we think that we'll get very strong support for shareholders, and we think we'll see more of it, and we hope to be one of the makers of that. Yeah.
And maybe if I could just summarize, I like to talk a lot about free cash flow. I'll use US dollars. ASX will be in Australian dollars, but Tomingley at a run rate, 7-year mine life for now, we think that will continue. At an ASIC cost of $1,500 to $1,600 US at most, that's a 40% plus margin, will generate well over 100 million US, probably 120 million US free cash flow a year. Costerfield, 50 to 80 million free cash flow a year, and we've gone as high as 90 million with the current gold prices, free cash flow US a year. And Björkdal, 30 to 50 million. Like combined, that is over 200 million. A free cash flow a year for now, pre-re-rate, a 650 million market cap company. The valid question shareholders ask, well, that's good, that's great, that's healthy. What are you going to do with that cash? And that's a combination of ensuring if you invest it, there's a good return through organic exploration and or through maybe we look at building a project or investing in expanding the mill, as long as there's a good return on that. And Nick can speak to Tomingley, but at both our operations, we have replaced resources at between 1% to 2% of the current spot price. That's a pretty efficient use of capital, not the only one. So, we will certainly keep that leg of the stool there, but we'll also look at more transformative deals in M&A if they make sense. We're not panicked. We don't have to do anything. We're not in a rush. I think we have shown we're pretty diligent, somewhat risk averse and conservative, so we've been measured in our approach, but we'll apply the same discipline going forward.
And do the funds, do they talk to you about dividends and share buybacks and so forth, just like retail would want?
Yeah, they do.
But what's their demands of you on that?
A lot of them just want to know what the plan is, right?
Right.
So we meet very few people that say you must do this or you must do that. Like everybody, they want to see capital discipline and total shareholder returns. Yeah.
Ultimately, a share price increase. It continues to go up, right? So
Exactly. Yeah.
Okay.
There's no mystery there, right?
No mystery. But it'd be great for you to get this out. Look, you've got to spend a lot of time getting to this point, and you've got a bit more time to get it over the line in Q3 at some point. I guess you'd be super excited to get back and focus on the business of growing the business.
yeah, sharing the story of what the next 5-10 years look like and what the next step is.
Yeah.
Bedding that down, chasing up some of the exploration things, because you can imagine, you're right. We've spent, we'll call it 9 months intensive work at a corporate level, pursuing this and other opportunities in parallel. There's a lot of multiple work going on because we're not haven't just been a one horse race the whole time, and so. Once you create a period of stability, then we can say, yes, this exploration plan that we were wondering should or shouldn't we do depending on A, B, C, D, well, we now know, yes. This one, actually, we're only going to do that because this, no. Across both companies, right? And so, yeah, we are looking forward to that period in the second half of the year of both integrating, bedding stuff down, but also launching into the next stages of growth together as a pro forma board, yeah.
Scale, re-rate.
I want enough
through
mate.
growth.
Yeah.
Fantastic. Good to see you, boys. Enjoy
Thanks,
the rest of your
mate. Great
trip
to see you
over
here in
here.
London.
Thank you. Love to
very
see you,
much, mate.
Fraser.
Yeah.
Enjoy yourselves bouncing around Europe and telling a pretty strong story. I like it.
Yeah, thank you.
Thanks a
It's
lot,
good.
Matt.
Appreciate it.